Ladies and gentlemen, we're back. We have another fun episode. Today is going to be a good one, as it always is. I think I say that every single episode. Dean, have I ever not said that at this point?
No, I don't think so.
No, because they're all good episodes. You think you guys should be used to it. That's why you're listening. Rental myths, rental income, rental whatever, everything to do with rent. We're talking about that today. Listen, whether you are buying a property with a suite, maybe you're looking to buy a few doors, Airbnb, whatever. If you like to learn, you're going to like this episode. Plus, we made it short and quick. So we tried something a little bit different today. A little bit of this versus that. How'd you like it, Dean?
It was fast. It was intense. I wasn't used to it, but it was fun, and I definitely look forward to doing that again.
Yeah, and I'd say like for 90 seconds, guys, for each topic in the this versus that, you're going to get so much from this episode. Even just, if I might say, just sharing that ourselves, we left with so much unsaid, but I think you're going to get a whole lot of help and information, and we answered a lot of questions, a lot of feedback, a lot of common concerns that people come up with. We just made things up. We sucked at talking, but no, I'm not selling it very well. It's a great episode, guys. You're going to love this one. Hey, by the way, we are still giving away that fancy Thrive mug for all you listeners out there who leave us a lovely 5-star review and send us a little heads up or a screenshot letting us know that was you on iTunes. Really helps us give back to you. Of course, please share the episode with your friends. Like it up on Facebook, on Instagram. Send us a screenshot of you listening to it wherever the heck you are. We love to see this stuff. We are at Thrive Mortgage Co. Today, I'm with my partner, Dean Lawton. I'm Alex McFadden. The third amigo is off doing business right now for us, which is fantastic. Anyways, I hope you guys love the episode. We will talk to you soon. What's up, guys? You are listening to the YVR Remo Show, where we talk all things Vancouver real estate and mortgages, take boring topics and make them interesting. Make sure to stay tuned to listen to everything you need to know how to put cash back in your pocket, create wealth in real estate, and simplify the complicated. Topic number one, claiming your taxes on your rental property versus not claiming it and just taking cash. So let's talk this through.
So what we mean with that is in your T1 generals, which is what you would submit to your accountant, how are you claiming your rental income on that tax summary or not? And it really comes down to, when do you have to? Like, what scenario would you have to do that, and what scenario would you say you wouldn't have to do that?
So right away, this is your business, guys. If you're buying a rental property, you should, first of all, from us, you should always be claiming your rental income. I mean, at the end of the day, that's like running a business and just taking cash. Now, we see this often with someone who owns maybe one piece of real estate investment or maybe a basement suite, but we've come across these situations where we've had clients who have had multiple properties. Now, you should always consider claiming your investment income for two reasons. One, tax evasion. Obviously, we don't want to recommend that. And then number two, qualifying, right?
Yes. Yeah, it makes a big impact to be able to show that income. You can use that income for the purpose of qualifying. So when would you not need to? Buying a house.
Yep. So if you're buying a house and you have a property that has a basement suite in it, we may or may not actually need to show that taxable income. Maybe if it was less than 1 year, but you do have to show it in your account. But I think the moral of the story, guys, is you should show it. You need to claim it on your taxes. You need a good accountant. And it's very important if you're looking to use that rental income to buy your next property. All right, guys, next topic, 90 seconds. Let's run through offset versus add back. Oh, and we'll talk about a bonus in a second.
Okay, so offset versus add back, we get this all the time. What is the difference? How is it going to impact me? So I'll quickly touch on offset, where we're basically taking the amount of rental income that is allowed, so the allowable amount of rental income, which is dictated by the lender that we're working with. So we take that percentage. Let's use 50% for this example. $1,000 rent, we take $500, and we literally deduct that from the mortgage payment, and that is how we use an offset.
Yeah, whereas an add back is a circumstance where we actually take that, let's say 50%. So if you're earning $1,000 a month of rental income, we take that $500, we times that by 12, so that's $6,000 of rental income that we add back to your application. Now, as you can tell, or you could probably imagine, that $6,000 of income is not nearly as much as, in this case, $500 deduction in your expenses. So generally speaking, we often favor the offset, even though it is much less prevalent out there. Now, there is a bonus. There's something called a rental worksheet or a DCR sheet in the industry. We're not going to go too deep on that, but if you can find a lender that uses a worksheet, which again, going back to the T1, is very important if you claim your taxes, that is an ideal circumstance. Just keep in mind, every lender uses different add backs or offsets.
Yeah, good points. And getting into the next topic, the difference of subject versus non-subject and how rental income can potentially impact that. So going a little over the clock here, getting into subjects and non-subject properties. What does that mean?
Well, subject is the property that you're moving into or the property that you're buying, and the rental income on the property that you're purchasing, right? So in the circumstance of a subject property, this means the property that you're buying and the one that's being lent on at that time is, in fact, the property that we're using the rental income. The non-subject property is the one that we're using the rental income from. So as an example, if you're buying a condo and you're lending on that property is the subject. But if you have another property that has rental income you're looking to use, that would be the non-subject property. Really, what does that even mean and why does it matter? At the end of the day, often we're having, questions from people about why can I use more rental income from my subject property but less from my other property, and vice versa. It matters, and setting up yourself for success means knowing these terms. Very important.
Very important, yes. And always understanding that key difference and how we manipulate the income or how a lender will look at it differently is so key. So that's a really good one to know and understand. 1 versus 2 to 4 rental. So what does that mean, and how are we looking at that? So what we're talking about here is there's 1 unit in a property versus 2 to 4 in a property. So think of a single family home or a condo that just has the 1 unit, opposed to say a duplex or a triplex. And how are we essentially looking at that, and how is a lender going to look at that?
So there's a few different ways that we consider these types of properties. Obviously, a property that has 2 to 4 units within it is going to have more rental income, but it also changes some of the rental allowances. You see, there are different programs for a 2 to 4. So the duplex, the triplex, or the fourplex in these circumstances actually have different programs which can be backed by the insurance agencies in case of Genworth. Now, you still have to put 20% down, but often if you are looking for a higher amount of rental income, lenders will actually be on board, or more lenders will be on board with the 2 to 4 unit rental to use a higher amount of rental income, because they can insure it, and in what their case is a lower cost to them when compared to that single unit rental. 1 versus 2 to 4. So in the 2 to 4, that does not include a basement suite. So your basement suite does not include in that 2 to 4 rental. That would be a single family home. So that'd be a single rental. Properties versus doors. This is a big one. Dean, do you want to explain that?
Yeah, so we get this a lot. So 1 door versus 1 house with a suite or a duplex. Understanding that a door is essentially just that 1 unit, where a property could really have 2 or 3 units in it. So understanding that is key, because some lenders are going to actually only allow you to have a certain amount of doors in your portfolio, or a certain amount of properties, and not just with them, but in general, your whole portfolio.
Yeah, think of it this way. If you have a duplex, and that duplex, each side, which we see a lot of these up in north, in the interior, and some other areas where there's a duplex that actually has a suite within it. So while there would technically be 4 doors in that unit, it's only 2 properties, right? So at the end of the day, just the distinction, whatever you want to call it, is it 2 actual properties, 2 titles, or is it 4? Whatever it is very important to distinguish between having a suite in a property versus actually being its own property and unit.
Yeah, it's key. If there's a title to that property, it's likely its own property. And we've seen this in like you mentioned, fourplexes up north where there actually is 4 titles on that property opposed to just one. So that it's very important, and it's something we look at with a fine tooth comb.
Absolutely. On to the next one, residential lending versus commercial. Okay, so this we really could unpack for an hour. So we're just going to give you some of the Cole's notes on this. Dean, you want to take it away on that one?
Yeah, exactly. So residential lending is typically when you're borrowing in your name. So your personal name is going to be on title of the property and the mortgage, opposed to where when we're looking at commercial lending, we're looking at a company being involved. The company is going to be on title. The company is going to be the borrower in that case. So that's a key difference right away.
Yeah, with commercial lending, generally speaking, like you have to keep in mind the commercial company or commercial lender, or the way that we've set it up, if you will, is considering you or your investment as a business. So we have to treat it like a business. It has to go in a business name. And of course, we have to be proving that this business is earning money. So it's really the qualification metrics around that are much different. You can't walk in typically, at least to your standard bank with your name and purchasing a property in your name and get commercial lending. There are some things that you need to consider as far as setting up a company, of course, and making sure it's going in that company's name. But there's also different advantages and guidelines when it comes to commercial lending as far as leniency. They don't care about you having a car loan or a truck loan or any personal debt. They care about that specific property and that specific investment.
Exactly. That's where we're looking at what we mentioned earlier, a rental worksheet or a DCR. We're really just looking at what is happening with that property, what's the expenses on that property, and what's the total income that's coming in on that property.
All right, another fun one. So typically when we see someone who decides they want to move up from their 1 to 2 door portfolio and start to move on to 3, 4, 5, and maybe more, we start to get a lot more questions about personal income and personal taxes versus holdco. And we see these questions come up more and more and more these days. And now I think there's something to consider as it pertains to the difference between the two. So personally means you're claiming it as a business. You're basically a sole proprietor, if you will, running your own business and claiming it on your personal taxes as a rental statement worksheet. Holy cow. A holdco is basically meaning you're setting up a business where you're funneling the income into that company and essentially buying the rental property in that company, which has some tax advantages that, have changed from time to time, but generally speaking can be beneficial.
Yeah, there's certainly tax advantages when it comes to buying a property in a holding company, but even more so, there's a huge advantage to buying a property in a holding company when you need to sell it. So when you need to go and sell that property, there's a lot of people that will buy their individual properties in individual holding companies, and it allows them to sell that property with ease. Meaning, for example, a divorce. When you get into a divorce, transferring property, transferring assets could be a lot easier when it's just transferring shares of a holding company opposed to actually transferring the property itself and incurring property transfer taxes.
Now, it doesn't come without its disadvantages, so keep in mind, not every lender will let you buy a property in a holdco, and it does have some limitations. There are some tips and tricks, but that's where we come in. We'll talk more about that another time. Next one, moving into...
Yeah, banks versus credit unions. So banks and credit unions are typically very competitive when it comes to just normal residential primary lending. But when it comes to rentals, this is very key, and it's very important to understand why a credit union may be a better fit and why a bank may be a better fit.
So generally speaking, what we found with a lot of the banks is they generally, but they have some good guidelines as it comes down to rental policies and some unique stipulations where they will stretch the budget, if you will, on their guidelines. Where the limitations come in are that they're very strict on what those guidelines are. So essentially, they'll give you a little bit more money, but their guidelines are their guidelines. You're not changing them. Credit unions have a lot more flexibility. They're generally more generous. So we're going to keep on that word, more generous as it pertains to the amount of rental income that they'll allow you to use. But some of the disadvantages is if you have time that's not on your side and you're buying a property, awful. They're very slow, they're smaller. They're also much more subjective, which means if they look at a file and they say, hey, we don't really like this, they'll can the file, they'll say no right away. So pros and cons, they will do things that other lenders won't, and they will have better policies, but they are a little unpredictable. Would you agree?
Yes, absolutely.
All right. Speaking of lenders, Conventional lending versus alternative lending, which has become huge since 2018 when the stress test came in, and since 2017-16 since the other insurance rules came in. Thoughts?
Yeah, so I mean, we just touched on 7 topics here. I had lost track, but we've touched on 7 buckets of topics here, and all of these items are going to be looked at very differently compared to a conventional lender versus an alternative lender. And when it doesn't quite work with the conventional lending, a bank, a credit union, an alternative lender is there with a little bit more flexibility in a lot of these terms and some of the ones that we're about to get into. That's where we can really see an alternative lender step up to the plate and make a deal work.
Yeah, to echo your point there, at the end of the day, it comes down to qualifications and guidelines. We had a lot of people that rode the wave in 2008 through 2014, 2015, where they could buy a rental property with 10% down and 40-year amortization, minimal documentation to provide. It's just not that way anymore, and that is the new alt lending. So we just suggest that your clients, our clients for that matter, think about this as an investment and act accordingly. You're buying this as an investment property, so if the numbers make sense, the numbers make sense, and if it allows us to get to 10 doors and you can make money off it, then it's just a deal, and you got to make sure that you can go forward with it. So you should always consider all of your options, whether it's conventional, alternative, or commercial, all the tools on the table.
Yeah, in closing, quickly, rates matter, and rates are different from lender to lender, especially with alternative.
Cool. Holy cow, we're down to the end of it. Let's talk through one more of this versus that. This has been a whole lot of fun. I think we should do this again. Short-term rental versus long-term rental. Does it matter? What are the types?
Sorry to cut you off. It absolutely matters. I was just speaking to a client today about buying a property that is an Airbnb, or they have the intention to rent it on Airbnb. Problem being is we don't have a firm lease agreement in place, so we don't know exactly how much that property is going to earn. Plus, with the seasonal interest in that property, summer months, they're going to make a lot more money than they are in the winter. This property happens to be in the Lake Country area of our province. So that is a very difficult property to qualify with really any rental income
in this scenario. So really, that's not saying that you can't use Airbnb, you can't do an Airbnb. Obviously, a lot of people do it. But what you should know about an Airbnb is a lender specifically looks at risk. That's what they're looking for when it comes to conventional lenders, okay? And what they're looking at is saying, okay, well, this property is only guaranteed to be rented out 1, 2, 3, 4, 5 nights at a time. We don't like that because it's not comfortable and there's risk involved, which is really what it is. There's no guarantee that you're going to rent it out for, a few nights or so. So when it comes to qualifying, generally speaking, we still have to look at the long-term potential rental income to qualify your property, although we are seeing some loosening of the guidelines, and we hope that continues in the next few years. All right, guys, we could go on forever. I felt like there were so many of those topics I barely touched on, but you know what? That's just a little juice in the can.
Yeah, absolutely. We're definitely going to come back on some of these items. I know there's a number of areas that I would have liked to add a little bit more depth to, but yeah, it was just more reason to share more information on these topics. So if there's any item here that you want to learn more about or you want to hear more about, let us know. We're absolutely willing to talk about this topic.
We got to leave them with some juice before the end of the episode. We're going to have a cliffhanger about no, we have no cliffhanger, guys. Thanks so much for listening. Make sure to subscribe. We'll talk to you soon.